Hello, everyone. Welcome and welcome back. I would say good afternoon, good evening, and early good morning. It really depends on where you are. We do have people dialing in from all around the world. I really appreciate your participation. This is our public lecture series on corporate governance number 14. Actually, this is a special talk on CoCo Bonds. Cassidy, could you please share the slides? Thank you. All right, so this lecture series is hosted by the Institute for Corporate Governance at Kelley School of Business, Indiana University. I'm Zhenyu Wang. I'm the director of this institute. It was founded in 2004, and we launched this series of public lectures in November 2021 with the discussion on ESG related issues. And the mission is really to facilitate the discussions between scholars, policymakers, practitioners, and to disseminate high quality research. So we want to thank our co-host, the ECGI, European Corporate Governance Institute, Marco and Elaine. In particular, Marco moderated the climate risk public lecture given by Professor Laura Starks last time. I think I'm going to see Marco again on Drexel's Corporate Governance Conference. Thank you, Marco. And the IU's Ostrom Workshop has also co-hosted the entire series of public lectures. All right, for today's lecture, we've witnessed some people use different terms. Some people call that banking stress. Some people call that banking crisis. I teach online MBAs right now. So we have almost developed every single week talking about the new issues. And at one point, which is not long ago, Credit Suisse and CoCo Bonds came into our discussion. And then I realized, look, we tend to study corporate governance excluding banks. But right now, what's going on started with the banks. Why don't we look into corporate governance of banks and the banking industry in general? And we have this expert who is right in my finance department. So that's why we added this special lecture on CoCo Bonds. Zhenyu is my colleague from finance department. Kristoph is going to introduce Zhenyu with more details. Our next lecture is next week, a week from today. This is a regularly scheduled on corporate culture and future directions. The speaker is Professor Kelley from UBC. And the last lecture of the whole series is Sustainability, a Consumer's Perspective. This is a marketing colleague from Arizona State University, Professor Niju Paharia. So I will put this advertisement right here. This is the QR code for next week's public lecture. Take out your device, scan it. So that would lead you to the link. We always share the recording, the slide deck, and our speakers answer to Q&As after the event, usually within a week, occasionally longer, because sometimes speakers are too busy to write up the answers to Q&As. So one disclaimer, I'm also running the finance department, and we realized the CEO of Silicon Valley was our own graduate from the finance department and of Kelley School of Business. And I joke with Zhenyu, our speaker, you teach risk management. What we have done in terms of bank risk management, Zhenyu said that was 25 years ago. I didn't teach that particular person of risk management. In any case, next slide. So our moderator is no stranger. Kristoph moderated the blockchain crypto asset talk of Vivian Fang. Professor Kristoph Kleiner is my finance colleague. He's associate professor. He started his career from IU. He does research in corporate finance with focusing on banking, bankruptcy, and he has been published in all top finance journals, Journal of Finance, Journal of Financial Economics, and Review of Financial Economics. Most recently, he won the Brighto Prize for Distinguished Paper Award at the Journal of Finance. And a couple of years before that, he won the Distinguished Referee Award from another top 3 journals, Review of Financial Studies. He's teaching fintech courses for both MBA, MSF, and undergraduate students. And he's teaching a doctoral class, Finance, Innovation, Labor, and Household. He's sitting, to my best knowledge at this point, 5 dissertation committees for doctoral students in the capacity as either the main advisor or co-advisor. And he's in hot demand. And he won the Best Mentor Award from Kelley doctoral student as well. So one last piece, Kristoph has done, I lost count, 10 or 12 interviews with media on the current financial crisis. I cannot find a better moderator for today's event. Kristoph, it's yours.
All right, thanks so much, June. So today's talk is motivated by the recent events both in the US and Europe. So as of March 19th, the UBS has agreed to purchase Credit Suisse. And that was largely aided by the Swiss government to calm financial markets. Now, one aspect of that deal was especially noticeable, and that was that the Swiss government said $17 billion worth of Credit Suisse bonds would get marked down to zero, meaning their holders would get nothing in their investment. This is really surprising because bondholders generally have priority over equity holders. What we need to realize is these are not ordinary bonds. These are CoCo bonds. So convertible contingent securities. It's a risky form of debt that converts to equity when predetermined trigger is met. Now, these triggers may be based on issuers' capital, they might be based on the balance sheet, or regulatory concerns. Now, CoCo bonds, convertible contingent securities, are designed largely in the wake of the Great Recession, and they were issued precisely to give banks like Credit Suisse and others a financial cushion in the event of a severe crisis. Holders of the bonds, however, are still angry about winding up with nothing while the Credit Suisse shareholders actually received UBS shares. So luckily for us, IU actually has an expert in this area and can kind of help us understand these events for the past few weeks. So Zhenyu Wang is a professor of finance at IU. He's also our Edward E. Edwards Professor at the Kelley School. He was formerly a vice president at the Federal Reserve Bank of New York, where he was head of financial intermediation. Previously, before that, he was on the faculty at Columbia University and University of Texas, Austin. He's published research in a wide variety of areas: equity, fixed income, derivative securities, asset management, financial econometrics, and he's won a large number of awards, including the Best Paper Award in Investments at the WFA. Beforehand, Professor Wang obtained his PhD in economics from the University of Minnesota, where he was also the Sloan Doctoral Dissertation Fellowship. Now, especially important for today, during the recent financial crisis, he contributed directly to the design of a wide range of programs: the Fed Emergency Liquidities Facility, the reform of the federal discount window for collateral management, the bailout of Bear Stearns and AIG, the security design of TARP, and most importantly for us, the development of new capital requirements for banks. And so with that, I'm privileged to hand it over to Professor Wang. Thanks for being here.
Well, thank you very much, Kristoph, and thank you, June, for giving me this platform to talk about this confusing CoCo bonds. So there are a lot to talk about it, and let me share my slides and on the screen. Does that work? Everybody see my slides? Oh no, not yet. Apparently, I didn't do it right. This is things. Yeah. Okay. I didn't share a screen. I think I just displayed the slides on my own screen. Okay, now, yeah. Okay, as Kristoph said, and there are a series of banking crises going on in both US and across the Atlantic. But then in Europe, the most recent, perhaps the biggest event is that a large international bank, Credit Suisse, fall apart. And there's a bailout, or you can call a bailout, the takeover and a bank failure, just like what happened to Bear Stearns, and similar to that. And in the 2008 financial crisis. So in this deal, and there's something that is different from any other type of acquisition or merger or takeover, which is the CoCo Bonds, okay? And today's topic is to focus about this CoCo Bond. You can see my title there. And now let me directly dive in and this deal to start my talk, okay? This deal was announced on last Sunday, and March 19th. And then in this deal, UBS agreed to buy Credit Suisse. Okay, that's everybody heard that. And this deal is brokered by the Swiss government. It's the trinity of the government sort of forced UBS and to take over. And here, this three regulatory or government entities are Swiss Department of Finance, the Swiss National Bank, and the Swiss banking regulator called FINMA. Okay, then this deal is all share transaction, and we all learned in the news that this deal goes like this: it's one UBS share will be purchased exchange for 22.48 Credit Suisse shares. And then this equivalent to about 76.76 francs and for each of Credit Suisse share. And that's amount exactly of 3 billion francs total. That's the deal. Then in the news and various media show pictures just like this, and basically shows how over the 12 years the two banks market capitalization depart. Okay, originally they are similar back in 2010. Then you come to the eve of the days of this takeover, and Credit Suisse value market cap is under 10 billion. So, and immediately as a finance professional, we look at the deal. So the first question, why 3 billion? Okay, and where does this number come from? And there's no information about that. I don't really know how they come up number, but I'll give my thought later and about what this number means. What does this number means? Okay, so in this deal, and a major surprising part is that the 81 CoCo Bonds are white paper, as news reported. Okay, the Credit Suisse currently hold in 13 of these bonds. Basically, these bonds are issued in various currencies, mainly Swiss francs and US dollars and Singapore dollars. And the par value of these total, come out like $17.3 billion. And then that's the sort of a calculation by people reporting in the media. And then when you look at this, it seems like it's a clear violation of absolute priority between debt and equity. This is surprise to people. When we look at the value of equity, and as I said earlier, the deal is 3 billion francs. That's amount to about $3.2 billion. But the value of the CoCo bonds in this deal is 0. So the bond received 0, the equity received a positive value. So how come we get this? FINMA's explanation is like this. It said the deal triggers complete write-down of these securities. And why do they trigger it? They said the purpose is to increase the core capital. And what does it really mean? I will go into detail to talk about it and understand it. Okay. An immediate question from investors and reporting news varies in all the places is that, is this really legal? Can you really do this? Are CoCo bonds debt or equity? So it's all confused. Okay, this confusion can be seen in the price. if you look at the CoCo bond, 81 CoCo bond price, and this is one particular security in Credit Suisse, and it looks like this. But at the beginning, well, it's around the $100 and on the par, but then it goes down and like a 40 cents or 50 cents on the dollar, but it's still positive. And when you look at this price, it looks like it's been priced like a subordinate diet. And when you look at all kinds of pricing suggestion tools floating around over the past 10 years, a lot of them suggest that this is similar to subordinate debt. So it's a debt. But then when you come to this deal, immediately plunged, and people learn about the wipe up, then they plunged to a few cents. And news reported that the dealers basically on the day after the deal, and dealers basically buying these bonds for about 2 cents on the dollar and selling for about 5 cents a dollar. Then this also raises a question: how come these are still worth a few cents, a positive price after the wipe up, if the wipe up should be zero? So what's going on? Okay. And then so the pricing when you look at the price, it seems like investors are confused. Then you wonder, are these investors sophisticated investors or not? It's hard to get information about the holding of this bond. So I collected these from various media reports over the past week. So apparently they all reported that the Saudi National Bank is probably the largest investor of Credit Suisse. They invest in 1.4 billion francs in Credit Suisse, and it just last year. And then the report said that after this deal over this month, and they lost $1 billion. And how much is the loss due to the wipe up of this CoCo bond? It's unclear. I don't have the information. Then another large investment is the how to pronounce Qatar Investment Authority. And they just converted 4.5 billion of that to really 81 Credit Suisse 81 bonds. But how much they are still holding, it's unclear. Okay. Then there are many other hedge funds and holding 81 CoCo bonds, and perhaps the largest one is PIMCO, and they hold around. This is the media reported that they hold around about $807 million 81 CoCo bonds from Swiss. But this is according to an anonymous person who is not authorized to give the information out. But Bloomberg calculated the Invesco and holds about 370 million of these bonds, and definitely will be wiped up. And BlackRock had 113 million in February, but it's unclear and how much they are still holding as this even happened. Another fund, the Lazard Capital, they actually allocated 7.4% of its so 1.45 billion euro of fund on just 81. The Credit Suisse 81 CoCos. Seems a large amount. And another interesting piece of holders are the senior Credit Suisse employees. And these people are paid as a compensation. So they are paid the 81 CoCos as a part of a compensation. And the bank's idea is that, well, if bank hold these things, you should hold similar portfolios, maybe, so that your incentive to be consistent with the bank. Apparently, they're going to lose. They're not going to be happy. So you look at all these; they are definitely sophisticated. But then when you look at the CoCo bond pricing, they don't look like that. Okay, and then so this is sort of. And I don't know if it's interesting or amusing, but this reminds me of an old writing, and which I sort of 10 years ago, and of a well-known writer right like this. So American comedian Will Rogers observed that you can't say a civilization don't advance. In every war, we kill people in a new way. And then in each phase of markets, the investors find new old ways to lose money. This is written by Satyajit Das, and who is the author of Traders, Guns, and Money. That's a famous book. He wrote this in Financial Times, I remember, in 2012. And then you can't help ask, so do they read prospectus of the securities they invest? Now let's dive into it. And when you look at the prospectus, and this security is designed to be both debt and equity. It's clear. And typically by rule to qualify as AT1, these CoCo bonds need to be perpetual. Then you need 2 triggers. And one trigger is the tier 1 ratio trigger using 7% level as a trigger level. So when your tier 1 ratio drops to or below 7%, and then you trigger the event, either I'll talk about it, either conversion or write down. Okay. In the prospectus is, well, Credit Suisse prospectus called it a consistency event. My understanding is to check whether it's consistent with the regulatory capital requirement. The second trigger is called it's actually a regulator trigger. In the prospectus is called viability event. And basically the regulator can choose to pull the trigger. So what happened to trigger? So let's talk about what happened before trigger. Before the trigger, this security function as a debt. The bank raises funds at par value, and then you pay interest regularly. And this way you have no earning dilution, and your interest payment mostly qualify for tax deduction, just like other bond. Then when you go to bankruptcy court, and this security actually has a higher priority. It's a senior than equity. So it's just like a debt, yeah. But, when it's triggered, it's a different story. When it's triggered, it's a function like a debt. And first, you can stop paying interest without any credit event. And second, then you convert to certain shares, and that make it like equity. Or you can just write down your par value, okay? But then Credit Suisse use a 100% permanent write down, and they call it bail-in. And what it does, it just totally wipe out. And that's part of the contract then. And this kind of design, as far as I know, is first proposed by 2 bankers. And these are actually Credit Suisse bankers, Paul Colello and Wilson Irving. And Paul was, I think he was the head of the investment bank of Credit Suisse, and Wilson Irving was the chief risk officer of the Credit Suisse. Okay, and I think they started, as far as I know, they already are pushing and propose pushing for these kind of design back in 2010. So this is the contract. So essentially, this really want to blur the line between debt and equity. So you lose value, so you can really lose value before equity. So if it's triggered. So you look at the design, yes. And when equity is still 7% of risk-weighted asset, not 0, then you can wipe out this. And you lose it before. Even if it's a write down, and you can lose it before it. But if it's a converted share, you end up with the same priority, okay? But if it's not triggered, and if it's directly sent to the bankruptcy court, and then you actually have the absolute priority, and it's a senior it's a senior claim than equity. So, well, this explains why the price is not zero after being wiped out. Essentially, these bond investors try to bet that the deal may fail and Credit Suisse may be sent to bankruptcy court. So, well, how much that chance, and I don't know. And apparently they price it at just a few cents on the dollar, very small chance. And then people may ask, well, if they're in the contract, how can they go to bankruptcy court? Well, this is a complicated legal issue, which I don't have expertise. Sometimes your contract, as far as I know, sometimes your contract may be conflict with some other existing laws, and people do challenge on it. Okay, then so now who traded, because CoCo Bonds as debt, and apparently bond investors traded price it as a subordinate debt. Then Credit Suisse also traded as a debt because they enjoy as cheaper funding as a debt. Okay, now who traded as equity, and then regulator do it. The regulator said it's additional tier 1 capital, it's equity. And on the other hand, and Credit Suisse said, yeah, I use that equity too. I meet your capital requirement. When you look at this, look at like a Credit Suisse everywhere, and it seems like this bank is doing arbitrage between market and the regulation. Okay, and then this wipeout surprised the bondholders first, then the right of the sort of the straightens the entire global AT1 market. And this is the price index of the AT1 market, a global AT1 market. You can see the large drop at the end. Then they come back, and while they come back, finally started realizing that other AT1 bonds don't have this 100% of permanent write-down feature, and people gradually realize that. And also, and on the next day after the wipe-up, and Goldman Sachs and other investment come out and say, well, and with this drop of AT1 market, it's a buying opportunity because many of the bonds don't have that. Let's look at this bond market, and media says that this is a $275 billion market. Okay, and here I just listed a few large banks issuance of these bonds. And seems like HSBC has the largest issuance, is $19.7 billion. Then it comes to the Barclays and the UBS. So UBS has a lot of these things. And then the BNP Paribas, and also Societe Generale, and then Santander, and also Deutsche Bank. And then, so do they have this write down or not? And most, I would say, most of them not, but the UBS and HSBC do, many of their AT1 have these 100% permanent write down clauses. So they are similar to the Credit Suisse. And but most others use a partial write downs or conversion to shares. And then, for triggers, and all 81 CoCo bonds must have a regulatory trigger. This is the rule of Basel III. And then, however, most of them also have a tier 1 trigger, except my understanding, except Canada. And Canada just use a regulatory trigger. Okay, if I get it right. So then, which are the countries issue most of them? Well, I would say this way: the countries with the most banks that issue 81 CoCo bonds. The most of these turn out to be China. The second is India, then Great Britain, and then Switzerland. And the least one, actually, US. In fact, none of the US banks have issued any CoCo bonds. Then you wonder why. Okay, so what happened to US? And so now here, and I would say US did consider it. There's a huge debate about the CoCo bonds in the US. And the leading proponents are sort of a Scrum Lake working group back in 2009, pick up the Mark Flannery's idea, really sort of advocated. And then Mark Flannery is probably the earliest sort of proponent of that. Then it comes with George Pinocchi, Calamiris, Harris, and there are other people. I just need a few here. Then the major banks also welcome and are pushing for CoCo. So one example is Goldman Sachs, and I think JP Morgan Chase also did so. I talked to one of the bankers, Goldman Sachs, why Goldman Sachs want CoCo? And his answer is that, well, after the 2008 financial crisis, definitely banks will see the capital requirement to go up. So you have to issue more equity. But if we can use the CoCo to replace equity, that will be helpful. That's their response. And then there are some scholars raising concerns. Michael also raised some and I wrote a paper, and then Admati and several other people and strongly opposed. There are others too, I just list a few. And then in terms of regulations in the US, first the US agreed the Basel III Accord. But the Basel III Accord doesn't count CoCo as a core tier 1 equity. The idea is that you cannot use CoCo bonds to satisfy the basic Basel III requirement, but you can use it as an additional tier 1 equity to satisfy the additional requirement set by the regional regulator. That decision was left to the regional regulators. Then this gives the US, and so leaves US to decide that. And in Dodd-Frank section 115, it does require US regulator to study, to consider using CoCo in regulation. But then 2 years later, and the US regulators, FSOC, wrote a report to Congress after 2 years study, and but that study is required by this Dodd-Frank, also the timeline, and is 2 years after the Dodd-Frank. So their decisions, no CoCo as a regulatory capital in US, and they want to leave it as a private sector innovation. So this is the situation in US. And then there's another factor might play a role, and that's the taxation. The US IRS, the tax code, and section 161L basically says if you have a security, the bond, the reference, or convert to equity, and then you're not qualified for tax deduction. So to US, if US bank issue CoCo, you lose this benefit. Which one plays bigger role? And I don't know. And so this is something that I'm wondering. And okay, that's the situation in US. That's why I end up there's no CoCo issued by US banks. And then why the other banks issue CoCo? What's really the main argument for CoCo bond? And recently I noticed that the news in Bloomberg keeps saying that the CoCo bonds is kind of security dreamed up by regulators. I don't think that's true. It's dreamed up by academics, seems like. And the proponent of CoCo bonds basically argue that the CoCo bonds allow banks to obtain obtain bigger capital cushion without issuing equity. So that seems to be the argument. Then you sort of recapitalize the bank by private investors when it's triggered. So when you need capital, it becomes the capital and at trigger. So when you don't need it, you don't need to have it. And this why we do this. This avoid the government or taxpayer support. Okay, but Mark Flannery and Charlie Calamirez and Herring like this, wrote like this, said academics and regulators conjectures that including sufficient CoCos in the bank capital structure could substantially insulate the taxpayers from private investment losses. And Calamirez and Herring also said that it will help solve our too big to fail problems. But when we look at this deal in this event of Credit Suisse, and it doesn't look like that. The taxpayer are at risk again after 15 years after bailing out the UBS. And because in this deal, the Swiss National Bank need to provide 100 billion francs liquidity line to UBS. So the taxpayer is on the hook. On the other hand, the Swiss government need to provide $9 billion franc guarantee for the losses of Credit Suisse asset acquired by UBS. So clearly they are taxpayer on the hook again, and that doesn't insulate at all. And when you look at it turned out last Friday, and I think last Friday, and then there's a poll conducted in Switzerland. It shows that 2/3 of the people do not support this takeover. So this becomes the question. This main argument for CoCo is in question. And the other things that we notice, the tier 1 ratio trigger, it seems useless. And this just 4 days before this deal, or before Credit Suisse will take over, and Switzerland, the regulator, put out the announcement like this: Credit Suisse meets the higher capital and the liquidity requirements for systemically important banks. The chart I put on is their basic requirement. It's I took it from their webpage, and then the Credit Suisse balance sheet, if you look at it at the end of the last year, that's the total asset is 531 billion francs, and liability, then you got 486. Equity is the total equity is 45 billion. But their core tier 1 leverage ratio is 5.4. Core tier 1 ratio relative to the risk-weighted asset is 14.1. If you look at compare 14.1 to this is 7% trigger, this is twice of that. Okay, so in this deal, how you don't really have this trigger to be triggered. You cannot use this to write down. The write down is really triggered by regulator, not a tier 1 ratio. So then, is that good? It seems too late, because a few days later, the Swiss finance minister came out and said, well, Credit Suisse would not have survived Monday if we didn't do this deal on Sunday. So, and seems like too late, okay? Then the tier 1 ratio doesn't do anything. So we have similar experience about the tier 1 ratio in the US. And if you look at Bear Stearns tier 1 ratio right before, it was taken over by JPMC, JP Morgan Chase, that's just 13.5%, according to people's estimate. Then Lehman Brothers is 10.1, and in the months of bankruptcy. And then now the recent one, Silicon Valley Bank, that's a 15.4% in December 2022. All of them are way higher than the 7%. So the tier 1 ratio trigger seems useless. And maybe for this reason, there are people like Flannery argue that we should use a market trigger because it's timely, objective, hard to manipulate. And then there are some other concerns. And my co-authors, Saunders and I wrote a paper, which is published several years later in 2015, said, well, if you use a market trigger, you often have multiple or no equilibrium prices. And when you have that, you lose the information about the bank value. And then you get a large pricing uncertainty and open to potential manipulation. And this is all theory, but then there's a group of economists conducting experiments and to confirm this indeed happens. Okay, so, and what is the current regulation about this trigger? And the Basel III clear says tier 1 triggers or regulatory triggers or both, okay? Never mention market trigger. But the European Union's 2013 capital requirement regulation clearly says no market trigger. If you use a market trigger, your CoCo doesn't count as a regulatory capital. Okay, then if you look at the practice, there's no CoCo bonds use market trigger at all. Okay, so but this debate is still continuing. This is another topic. I can talk for another hour, but I'm not going to go talk more about this. I just leave it here. Okay, another question is that well, what is the incentives of CoCo bonds in corporate management or governance? And people argue that CoCo may help to mitigate risk shifting problems. Okay, and then but back in my paper with Sanderson, we said, well, if you think of this way, if CoCo's par is C and conversion ratio is M, and then the convert to M shares, and then relative to suppose you view the entire bank share as one share, then conversion price is K. Then the conversion and will replace the par value C by the MK. M, the number of share times the K. That's what the CoCo holder will get at the conversion. But then if you set M times K is lower than C, you subsidize the prior equity holders. Okay, you rip off the CoCo holders. But if, or you do the other way, then you punish that. But then most follow-up paper says, well, then we should have set MK bigger than C, so that you punish equity holder for running bank down. Okay, so that's typically the what recognized design. But if you look at the CoCo, this Credit Suisse CoCo bond structure, it's 100% write down. That's the equivalent to convert to 0 shares. Okay, then clearly you so this write down will subsidize and will subsidize the equity hold existing equity holders. And what's puzzling to me is that majority of CoCos have a write down clause, and it's a partial write down, but still subsidize equity. Okay, they design that way. Totally contradict to the things that we do in theory. And so doesn't this incentivize the bank manager to run the bank down to trigger? So you can't help answer that question. So there are several academic studies on the CoCo incentives, and at least a few papers over there. But clearly, this should depend on design. But then also, there's a problem in these papers, and I would say shortcomings and not problems, because this paper assume that, well, when you put a CoCo, just existing bank liability structure, then you have CoCo, what happened? It doesn't seem a bank would strategically optimize their balance sheet. But if we do that, it's a different story. Here, I would like to mention, to review these sort of the restrictions and interaction with the bank responses. So in corporate finance, we all know, so equity is like option. So it's a convex function of asset value, so higher risk and higher value. Then Leland and Toft and the Prosik, they have papers of the governance can help, the bond governance can help remove such convexity. So in corporate finance. But in the banks, and the people recognize, yes, and this restricting incentive is there too, but then bank capital requirements, it should function like a debt covenant, right? So then it would hope this will help. So this is sort of, Suresh and I analyzed this in our paper, and basically we find out that if you fix the bank liability structure, okay, equity indeed will be a convex function of asset value if capital requirement is low, even is rather low. But when you raise it, indeed you can remove it. Okay, but the problem is that that assumes that the bank doesn't respond to you raise of capital requirement. If a bank says, okay, you raise capital requirement, I readjust my liability structure, I need to optimize it and again maximize my bank value. But after they did that, then the convexity stays there. So if bank optimally responds to you, and it seems it's hard to remove that. And this kind of responses and defect response have never been analyzed in the CoCo Bonds. And that's something that sort of we need more research. And then the other thing is that, well, people argue that triggering CoCo can stabilize bank. Some other may worry that maybe destabilize it. And for academic study on this, there's an interesting study by Valley and which try to see what a trigger event will do to the bank stability. But there are not many triggers. So what he did is that to use the Europeans' liability management exercise to infer it. What did he find in the paper inferred is that the triggering CoCo may help bank performance and end up higher ROA, and triggering CoCo may send a positive signal and higher bank value, and the bank then also define the bank do not, they infer, bank do not try to avoid triggering CoCo. But we see very different things in this Credit Suisse event. And when we learned that no more Saudi capital will help them, and then they were taken over on a public assistance. And in the Taylor deal, and it's given much lower bank value. I will talk about that. Okay. Now we also have some prior near trigger experience, and especially by Deutsche Bank in 2016. And at that time, when they got close to trigger, and then the CDS spread of Deutsche Bank suddenly widened to 248 basis point, stock price dropped by more than 40% in a couple of months. And then Deutsche Bank try to avoid the conversion and offer to buy back $3 billion €3 billion of euro debt and $2 billion of dollar debt. And then after that, the CEO at the time is John Curran, he complained. He said, they are not a great instrument, and we shouldn't really need them going forward. Seems after this, this CEO doesn't like it anymore. Okay. Then the bottom question, the largest question is, maybe most important question is, does CoCo really help financial stability? And this is the key part for using CoCo in regulation. And very influential, maybe widely cited research is by Adjective, and this is a paper floating around a long time. It's several authors on it, and it's only appeared in print in 2020. So what it shows is that the issuance of CoCo bonds reduces CDS spread. Okay. Well, And if you think about the CoCo bonds seniority to a senior bond, and that's what it should be, right? Because they issue lower tier bond, and then of course the senior bond, and you protect the senior bond. Then the other things that they find is that the issuance of write-down CoCos raises stock price, but those conversion CoCo doesn't. But when you think about write-down CoCo, oh, well, it subsidizes equity. Of course, it should raise stock price, right? But the before I go there, so and the authors are careful enough that they don't say this is just mean they help financial stability. But my struggle is that many other people, when in the other papers, always cite this paper's finding as evidence that CoCo help financial stability. Okay, and the relevant question was what if they issue equity instead of CoCo bond? Isn't that better or worse? And that question is not answered. But when we look at the 81 bonds and Credit Suisse, and I would understand how CoCo bond help financial stability this way. And because the CoCo bonds actually help Credit Suisse to avoid being nationalized and avoid the massive liquidation of the bank. Here I listed a few numbers, again, the total asset, liability, equity. But the 81 YPOP, we see it's 16 billion. Takeover price is 3 billion. But in this deal, what's not in the public announcement, which I took me time to find out through various channel, now it's hard to find, is that there's a badwill write down for asset. That's a 56 billion. That's not in the announcement. Okay, so the 56 billion, so it's a discount from asset value in this deal. Basically, a little uncertainty and for this bank's asset. And this is very typical for distressed firms in takeover. And there's a certain rule of accounting regulation for dealing with this. But now, then you wipe out 81, what you see is the equity value will be the total asset value 531 minus the badwill 56. Then minus the debt, but the debt is 486. Then you subtract the 16 billion of wipeout to reduce the debt obligation. You're left with 5 billion equity value. That's the accounting here, my guess. And that means at most the UBS would pay 5 billion. But so if you don't wipe up, what happened? If this is a regular bond, if you don't wipe up, you don't have this 16 billion taken out, your equity value would be negative 11 billion. Then you can't find a buyer. That means they have to go to either nationalize it or liquidated and through bankruptcy court, and that would be really messy. Okay, so in this sense, this wipe up really helped by not being regular debt, by being an CoCo debt. And but the same, this helps, maybe helps financial stability, but none of the academic papers are really chopping down this role, okay, in the CoCo bond. And in fact, how much they can pay, they have to pay, but the regulation says that to make Credit Suisse a going concern, you have to have a tier 1 ratio to be 14.3%. Okay, and majority have to be equity, common equity. But now the 81 already wiped out, but of course they have to use common equity. That means that they have to inject more equity. And now when you inject $3 billion, that brings the new Credit Suisse and tier 1 ratio to be 15.3 above the 14.3, well above it. And the leverage ratio will be 5.86. And that's the role of $3 billion. But if you reduce that, originally on Saturday, the offer of UBS is 1 billion. If you use 1 billion, it's just barely above it. I calculated that the tier 1 ratio will be 14.5, and the leverage ratio will be well above. And how low can you go? You can go down to $500 million. So that's the lowest price, takeover price you can do. You have to put in $500 million, otherwise the asset takeover will not satisfy the capital requirement. So the range must be the lowest will be $500 million, the highest $5 billion. Apparently, finally they did $3 billion. So that's what Charlotte gave sense about this evaluation. So there are lower bound constraints that you have to put in money so that it's ongoing concern. But that the maximum value is 5 billion. Well, you can't help to argue, well, this is helpful. Seems like a CoCo help this way. And that's my understanding why this helps. Well, but you can't help wondering, what if they had issued this 16 billion as equity in the first place instead of CoCo? Would that be better off or worse off? I don't know. So that's the question that I have. Okay. Finally, let me wrap up. So what I did is that basically reviews, and at the bottom line is the CoCo bonds are both debt and equity. Some say maybe neither. Here I would like to quote John Coran again. After the Deutsche Bank event, then he come out and said, well, this is kind of like a convertible bond. But when you want them to be debt, they are equity. And when you want them to be equity, they are debt. That's how he feels, okay? And then for academics, and the true color of Credit Suisse CoCo begs for a series of questions. First question is, why do banks issue CoCo? And earlier I said, I feel like Credit Suisse is doing regulatory arbitrage. Is that true? Is that the real reason? I don't know. And when you try to answer this question, you also need to answer how much. How much is optimal? And that gets into the issue of optimal bank liability structure. And for the given regulation you put out there. And then whoever, I have seen many papers, several papers, try to explain, claim they explain why bankers issue CoCo. But no paper can really explain why US banks don't issue CoCo. I would argue, and because when you are used their argument, it seems like the US should issue CoCo too, and if based on their theory, but the US didn't. So anyone who explain why bank issue CoCo, you have to explain why US bank don't issue CoCo. Otherwise, I don't believe the answer. And the other big question, definitely, can CoCo bonds really help financial stability? This is what we want, okay? To answer this, there are several sub-questions that are already raised. And one is that can CoCo be used to insulate taxpayers from bank risk? I'm not sure about that. And how should we design so that it does that? And also, should tier 1 ratio be replaced by something better? And or how to make a CoCo discourage bank risk shifting, and how to make a CoCo trigger event to stabilize the bank rather than sort of cause chaos in the market we often see. And also, how can CoCo avoid nationalization and liquidation in the bank? These are something that I haven't seen in the papers. And well, at the end, as I just alluded, and in the accounting numbers, how this CoCo actually helped to avoid this Credit Suisse bank to be liquidated in a chaos. So, and so a lot of questions here. I think there are a lot of research to do on this. And so I think that's all I want to say. Okay, yeah.
All right, well, thanks so much.
Yeah.
This was incredibly helpful. I've learned a lot the last hour. I think we're very lucky to have you here today. We're also very lucky to have you at IU, so you can help us kind of understand these events. So for anyone in the audience, we have a Q&A button. Please, submit your questions. We already have several, and we'll get to as many as we can in the next 15 minutes. So I want to start with some questions specifically about kind of the details of the Credit Suisse case. And so the first is from Mark Reeser. So he says, for the Credit Suisse AT1 bond, was it possible for it to convert to equity, or was only a write-down possible?
It's by the clause or by the securities terms, it's only write-down. You can't convert it, okay? And that's the clause. And so it's, that's what the regulator did. Yeah.
And then on a related question, Jenny Bai asks, how does this wipeout event affect the welfare of debt holders and shareholders at Credit Suisse?
Definitely, it depends on which debt holder. If a CoCo debt holder, if you count them as a debt holder, definitely that'll hurt them. And because people even say that you remember the Credit Suisse employees hold a lot of CoCos because they got paid with the CoCos. And I think this practice started from Barclays and nearly 10 years ago. And then I remember reading their proposal contract and even Cito once and when he presented those things. But in this event, it turned out that definitely those will wipe up. So people say, well, so the Credit Suisse employees bail out their own banks. Okay, so that's the original designs are there by those Credit Suisse bankers that bail in rather than the government bailout. But the problem is, like when I mentioned this, is that the private sector bailout is not enough apparently. And by the time you come to this point, you still put a taxpayer on the hook. Okay.
So Rajiv Bhutani asks, for the investors to bear the risks of the wipeout, what was the spread on these CoCo bonds over comparable bonds, standard bonds?
I don't know the spread. Depending on when earlier, then I think the typically it's very often to see. I remember in other years look at the CoCo bond yield. It tends to be around between 7 to 9%. So it's pretty much look like a subordinate debt. Okay, then of course, and after the wipeout, and then even near the wipeout, these drop to and below 50 cents per dollar. So you can imagine how high the yield is. And then at the end, it's a few cents of a dollar. And so it's and when you not much point to compare to yield anymore. Yeah.
So Jamie McAndrews asks, so suppose one confines CoCos to regulatory triggers based on a resolution or merger and allows only write-downs, not conversions to equity. Do you think this qualifies as tax deductible under IRS rules?
That's a very good question, but I don't really know. And this is you need some tax expertise for that, and I'm not. And yeah, the earlier the U.S. really get in trouble with the conversion because originally we all think about conversion. But to be honest, yeah, if you rely on tier 1 ratio trigger, you may still get a problem because you reference equity value. So you have to remove that. Only use a regulatory trigger, then you avoid this rule. Okay.
And as another question on the regulation, so Nicholas Godek asks, do you think the lower technical trigger level is meant to give regulators more flexibility? And what are the benefits of this structure?
In fact, the 7% trigger was called high trigger. It's high trigger CoCo, and they don't think it's low. Okay, and 7%, that's the basic Basel capital requirement for all banks. So then the question is that, should we make it even higher? I don't know. You can see that at the bankruptcy, their tier 1 ratio is 14%. Do you want 14%? And so it's seems like a tier 1 ratio, how high is that? It doesn't solve the problem. Okay. Essentially, the regulator trigger need to kick in earlier. in my view. But that never happened, given the politics there. And you see that this one is quite late. Okay, back in the papers, Sanders and I wrote, we wrote it down, speculate the regulatory trigger will not be early enough. Then you define the whole purpose of CoCo. The early argument of CoCo is that you get capital, convert to capital timely. But when regulator convert, they pull the trigger very late. And until things are really bad, they pull the trigger, then it can never be timely. So that's the issue there. Then I already talked about the tier one can never be timely. Okay.
So, and then a related regulatory question. So are the taxpayer risks in the takeover really due to the fact that the AT1 was written down while there was still value in equity? Would the deal have occurred without taxpayer risk if Credit Suisse had issued equity rather than AT1 bonds? This is a question from Paul Davies.
Oh, okay. I think the government support is basically to sort of hedge the UBS risk, takeover risk, because there's 9 billion franc guarantee for the potential loss of credit asset, and basically, so from UBS point of view, it looks like this. I'll take this company. I look at the value, but there's huge risk there, and then I'm willing to take the value, but I cannot swallow too much risk. So this guarantee help to hedge the downside. And then also because of this, I may end up need more liquidity. So the credit line is very important. So basically government support so that UBS don't go down. Otherwise, and then this risk can bring both banks down. That would be terrible. So you got someone saving someone from the river, but then both get drowned. Yeah, you could end up with this. But this happens, same thing. I remember, so I was personally involved the bailout of Bear Stearns. We call it bailout. It's not really bailout. It's the JP Morgan Chase taken over. Over there, we also provide $30 billion loan to JP Morgan Chase. So the public is on the line always. And it seems without this, these banks won't take the deal. Yeah.
So, and this is, again, another regulation question, also from Mark Reeser. So other than market equity prices, what other factors would regulators consider when deciding whether to trigger a CoCo?
I think a regulator only, as far as I know, consider these accounting trigger, consider the regulator trigger, consider the market trigger, and that was debated for a long time. And in fact, back to 2010, 2011, US regulator, and based on my knowledge, they didn't like regulatory trigger. They didn't like the accounting trigger. They knew that it would be late. It doesn't work. And when I remember when the early proponent, sort of people argue for CoCo, and one of the main argument is that when we use for a market trigger, if we use a market trigger, so we don't have to leave the decision to regulator. Okay, then we will avoid accounting manipulation because. And it's well known that Lehman Brothers used Repo 105 to manipulate their books before they fall apart. And there are a lot of good arguments about the market trigger, but it technically becomes a problem because the market prices depends on when you convert or not convert. To keep the consistency becomes an issue. And that's the things that Sanders and I pointed out. And once we point out this problem from a fundamental finance level, you cannot put a rational price on it. And then the US regulators say, okay, the market trigger doesn't work, so seems like I don't like it. And they did, so my sense is that they didn't like accounting trigger, they didn't like the regulatory trigger. Then at one time, they think the market trigger sounds good, but it turned out once that one is not implementable, and then U.S. regulator seems to stay away from it. And the main thing that looks like very complicated. Yeah.
Okay. I have a couple questions specifically about the U.S. So as you mentioned, CoCo Bonds are not currently in the U.S. So William A's asks, if CoCo Bonds were issued in the U.S., what is the risk that taxpayers would be on the hook to bail out substantial holders? We've seen the FDIC arbitrarily go beyond the state limit with Silicon Valley Bank and Signature. What would stop the government from bailing out CoCo holders?
Yes, but this, yeah, basically what you see is that I think that this is a lot of question, and the bottom line seems like you're asking whether CoCo Bond, if CoCo Bond issued in the U.S. could help U.S. government avoid a bailout like Silicon Valley Bank. Based on the experience that we had, it seems like it doesn't avoid that. Okay, so the whole point of these, like in the Credit Suisse case, Credit Suisse has a large, I forgot the number, a large amount of also the deposit there. Okay, and what you really regulator really want to protect is the depositors to deposit, and so it's and I'm not sure a CoCo can solve this problem, and maybe you're thinking that whether CoCo can help this sort of reduce the burden on the deposit insurance. Right now, we're debating whether it's unlimited, how high is it to be, and that issue came up. And definitely, is unlimited deposit insurance will be a huge burden of public and of taxpayers. But you think, well, if bank issue CoCo, then maybe we don't need that much. And there's another issue that the CoCo typically issued by large banks. And for mid-sized small bank to get into this market in the same like so far we don't see it because it's complicated security. Yeah.
And then I'd like to just conclude with two questions from our colleague, Chuck Chizinka. So first, does the failure of CoCo tell us something about corporate governance of a specific bank? And more generally, are U.S. banks better governed?
I think U.S., so whether U.S. government, maybe the questions understood this way, maybe you're thinking U.S. banks didn't issue CoCo because they are better governed. And well, I think this is because regulation doesn't come. Because my understanding, several U.S. banks really want CoCo. They argue at Basel. And they think I remember many years ago, Bloomberg has a report saying that the Basel decision is a slap on the face for U.S. Wall Street banks. So if you count as a regulatory capital, and they're going to issue it. And that's my view. They really want it. And the main reason seems like, I'm not sure how much about tax. I really think is whether regulation counted or not. Essentially, so that makes me suspect whether this really just gave them a regulatory arbitrage that I talk about it. Okay.
And then finally, after the Credit Suisse experience, is there any future for CoCo Bonds?
Oh, many people actually sent the email and say that is this the end of CoCo Bond? It's hard to predict, and so definitely this is going to be make it hard for U.S. regulator to count as CoCo. Yeah, given this event, and for futures of CoCo, and that depends on whether the regulator want to change how they view it. But definitely, some regulators could argue CoCo helps, like toward the end, I argue, and the CoCo did play a positive role in avoiding nationalization, avoiding this massive liquidation. Okay, so I would say It's definitely going to die. But the investor will price them in better in the future. Okay, they will realize that this is not just a subordinate debt. Okay, then that will definitely make issuing CoCo more expensive, I guess. Yeah. Okay.
All right. Okay. Well, thanks so much. This was
Okay,
incredibly
thank
helpful,
you.
Zhenyu.
Yeah.
We all appreciate it. June, I'll hand it back to you.
All right, thank you so much, Zhenyu. It's a fascinating lecture. I've learned a lot. I know you are an award-winning teacher from my experience, but this is really informative. And maybe we can do a little bit more bank governance or even the Federal Reserve System's governance in the future. Coming up, we have next week, next Thursday's Corporate Culture and Future Directions by Professor Kelley from UBC. My colleague Ankit Kelda will be the moderator, and the last lecture for this year is going to be Sustainability, a Consumer Perspective. So thank you for attending. The last slide, I have the QR code for the coming lecture next week. So all of our lectures will be recorded. You will receive an email on the recording with the slide deck, and there are many questions, 18 questions in total, some of which Zhenyu didn't have time to answer. So Zhenyu would write up his answers to all questions, including the ones he didn't have a time to answer. That way you could have a more comprehensive understanding of the CoCo bond issues and maybe related issues on bank stability and perhaps the future paths for the banking system. Thank you again, everybody. Thank you for joining us. Hope to see you next week. Bye.